We've been very pleased with how the portfolios have performed through to the end of the financial year at June 30. The majority of portfolios recorded very strong double-digit returns, and again this was a factor of good market positioning as well as the strength of underlying equity markets. On that note, the Australian equity market for the financial year returned a full 17.4%, and the international equity markets, measured in Australian dollars, generated a 20.4% return. What was interesting about that though is the Australian dollar actually appreciated over the financial year. So whilst it's been through a structural fall in trend, during the financial year it actually appreciated by 3.2%. Now, given we hold good positions in international equity markets in the portfolios, that actually detracted from that performance. So that return of 20+% that I mentioned in international markets has been after the impact of that currency. Weakness is continuing to be seen in fixed income markets, and as we've been talking to you for some time, we see these markets continuing to be overpriced. So with the Reserve Bank continuing to hold their cash rate at 2.5%, cash delivered almost returns in line with inflation, so close to the zero real returns we've been talking about out of that asset class for a while. And in addition to that, Australian government bonds returned a return of about 5% over the year. So again, a real yield of a few percent, but still, in our views, on a pre-fees basis, not enough to justify the risk of capital losses as interest rates increase in the coming years. Well, those returns I just spoke about over the financial year really could be thought of in two ways. The first 6 months of the year up until December 13 was really very, very strong returns and generated the majority of the return for the year. What we've seen so far in 2014 is markets have been a lot more sanguine and returns have been a lot flatter. So for example, the Australian equity market, of the 17% that it returned throughout the financial year, 14% of that was returned in the first 6 months, and there's only been a few percent return so far in the 6 months in 2014. International equity markets have been even more extreme, being flat, and that's really been a function of the fact that the currency that I talked about earlier has whilst it had depreciated by a couple of percent up until December of last year, has really gone the other way, and it's rallied 5% in the first 6 months of this year, offsetting the gains that have been made in local price indices for equity markets. Well, it's a good question to ask as to why have markets' returns been a lot lower in the first half of 2014, so the second part of the financial year. Well, one of the core reasons is just the fact that markets are actually approaching fair value. A couple of years ago, we positioned the portfolios to overweight these risk assets, so equity markets in particular, of the view that the world economy and global markets were actually in a lot better position than what the valuation stood for. Now, we benefited very, very materially as over that time frame, markets have appreciated very, very materially. But ultimately, as prices reach or at fair value, which is consistent with our view, then the return expectations from them has to also change. The other offsetting factor, which I've already talked about, is really just some short-term volatility in the Australian dollar, which is a function of as quantitative easing programs unwind, and as some of the central banks, particularly out of emerging markets, try and find other foreign currencies with which to hold their foreign currency reserves, the Australian dollar has been a beneficiary, will be caught up in some of that currency volatility. The final point that I'd make is ultimately, with markets approaching fair value, equity markets only can be driven from this point, will primarily rather be driven from this point by ongoing earnings growth. And ultimately, earnings growth is positive, but earnings growth is really not as strong as what we saw back in 5-10 years ago, where it was approaching sort of the high single digits. At the moment, sort of global earnings growth running around that 3 to 4%, and therefore what you expect from that is equity markets need to run a path which is more consistent with underlying earnings growth. Otherwise, they start to become materially overpriced, which of course is always a factor that they're capable of doing. Well, as I just mentioned, we're still positive on market outlooks from here, and that's really being driven by those two factors. First of all, we're very, very comfortable about that ongoing economic recovery on a global basis. Whilst we continue to see that the global economy is not very, very strong, it's robust and has sufficient momentum to carry these markets forward. The second thing is, as I mentioned, we don't see markets as being overpriced, with the exception of fixed income markets. We're going to continue to avoid fixed income markets because as these global economies continue to improve, as quantitative easing continues to unwind, those fixed income markets will continue to stay flat or fall in value as interest rates rise. In terms of the outlook though, I think one of the other factors that it's just going to be fascinating to watch, because the world has actually never seen this, is over the next 12 months how markets respond to ultimately what will be the ending of the quantitative easing programs, in particular led by the US. So on the current pace of economic expansion, the US QE program should end about October this year. So just to remind you, this was a program that was initially, at inception about 18 months ago, impacting about $1 trillion of cash into the US economy. Okay, they're slowly winding that back on a month-by-month basis, and they're due to end that in October this year. Now, the step after that will obviously be the market will start to turn their mind to the potential for interest rate rises. And as we've already seen over the last 12 months, that has really very, very material impacts on global markets, in particular on emerging markets, because higher US interest rates mean that people require higher returns out of these emerging market economies to compensate for the additional risk. That meant that money was very cheap in the emerging markets when US interest rates were zero, but as they start to increase, then the emerging markets, as we've already seen, will be forced to actually increase their interest rates as well, irrespective of where their current economies are at. Now, that will have an impact on their equity markets, it has an impact on their currency markets, and that volatility is something that we'll have to watch and see, and we're very mindful of in managing the portfolios. The final point I'd make is the ongoing risk of geopolitical risk over the next 12 months seems to be increasing. Ultimately, one of the key elements of geopolitical risk that we're concerned about is impact on oil supplies. Now, the US certainly as an economy is a lot less dependent on global oil than it was, and this is really because of the shale revolution in the southern parts of the US, making the US almost self-sufficient for oil production. But ultimately, oil remains a key cost in the global economy, and any geopolitical risk that results in a material step up in the oil price means that ultimately there's a risk to global growth. If you think about what's going on in the world, ultimately with the Ukrainian crises continuing and Russia being a major oil producer, also with ISIS in northern Iraq and Syria continuing to expand geopolitically, as well as the new footprint Israel is continuing to expand in the Gaza front, really have a continuing number of very, very material or potentially material events that could impact on this front. And it's just something, again, that we're mindful and cautious of over the next 12 months, again, given market prices are approaching or at that fair value mark. The final question we have is, what's new? What are new opportunities that we're looking at in the portfolio? And on this front, we'll continue to talk to you about some illiquids opportunity, and in particular commercial real estate within Australia that we're beginning to invest in. We have a good pipeline of assets that we'll be looking to acquire in the portfolios. In some of the mandates we require your approval to be able to invest in those, but these assets continue to be mispriced following the global financial crisis, and we're expecting returns in excess of 10% from these assets, so it really is one of our preferred investment opportunities in the portfolios at this point. But as always, we look forward to keeping you up to date with both the markets and how the portfolios are tracking, and we continue to be confident about 2014-15 financial year being again a strong and positive year for the portfolios that we're managing.